Alright guys, just doing a video on business structures. I'm not going to be going too much over the notes that are already in your book. I will ask you to read those, but we'll be spending the time doing going over the advantages and disadvantages of the three different business types. So we're going to be looking at sole traders, partnerships, and companies. Each structure has its own particular advantages and disadvantages. So a sole trader is what a lot of small businesses are. It's a business where one person owns and controls the business. So they also generally do the work of the business as well. So builders, plumbers, tradies basically, hairdressers, gardeners, corner shop owners. Now, advantage. Well, they don't need to share their money. So income is not shared. So they get to keep it all for themselves. That's pretty much the biggest advantage of that. Whereas the disadvantages are that responsibility is huge for this one person. Responsibility is great for a single person. They have to do the work of the business, they have to handle the money, they're responsible for paying the tax on their income, so that's quite a lot of responsibility for the one person to handle. Also, low startup capital. So what do we mean by that? Well, businesses cost money to set up. If you're one person, you're going to have to save all that money, and being the one person, you might not have all that much to throw at a business to get it started. So those are the advantages and disadvantages for a sole trader. Having a look at partnerships. So partnerships are businesses owned by more than one person, usually between 2 and 20. They are always governed by a partnership agreement, unless it's dodgy, and then they get the lawyers involved and argue up when something goes wrong. But usually a partnership agreement that sets out rights, responsibilities, liabilities, and everyone's duties. And most importantly, it would specify each partner's shares of the profit. So really this is where the maths is going to come into it. If you ever see a partnership in a question, the question will always say how many percent of the business's income one person will get, and then they get taxed on that. So that's really the only difference that's going to be between a partnership and a sole trader. It's just like multiple sole traders from the one business, really. So examples of this are lawyers, accountants, doctors, dentists. And what are the advantages? Well, unlike the first, the sole trader, there's more potential for more startup capital, because there's more people involved, more money can be thrown at a business. A bigger business can be set up. And also, like there was a disadvantage with the first one, the sole trader, of having to deal with a lot of responsibility, here there's less individual liability. Other people can take responsibility for certain things. One person doesn't have to do all the work. Well, the disadvantages, well, one of the advantages for a sole trader was not having to share. Income must be shared for a partnership, so that's a disadvantage. It's going to have to be split, and also because you're working with other people, people don't always agree with each other. People don't always agree with the way another person works, so potential conflicts are a disadvantage of having to work with other people. So that's partnerships done, advantages and disadvantages. If we have a look at the company, company is the most complex form of business structure. Companies have to deal with an act of parliament, so they have to deal with a lot of rules and regulations from the government, which costs them money a lot of the time, and they might have to employ specific people to handle those responsibilities assigned by the government. So there's a lot of what we call red tape that they have to deal with, and only the biggest and most successful businesses will ever bother to take the form of the company, because they're earning so much money they can take that take that time and energy to deal with all that stuff from the government. Companies are owned by shareholders, and the profits are actually distributed to the shareholders as dividends. Companies are run by a board of directors, and those are chosen by the shareholders through vote. Also, most often companies are called limited liability companies, and that means the company's owners are only liable for what the company's worth, or the worth of their shares, or the assets of the company itself. And their property doesn't ever come into under attack. This is unlike sole traders and partnerships, where if they've got debts or they're struggling and they need to pay off things, those debts might be paid through taking the owner's private things, so like their car, their house, all the contents of their home might be taken. Whereas limited liability companies, only what the company already owns itself can be taken, not the property of the people running it. So some examples of companies are BlueScope, Rio Tinto Group, Santos, David Jones Limited. If you're listening to the share market reports at the end of the day on the news, you'll probably hear those. So what are some advantages? Well, obviously that's a big one, that limited liability thing. Limited liability. So owners' personal assets are not risked, even if the company's not doing well. There's a huge potential to make money from the shareholders by selling shares, so huge money making potential. By selling ownership, which is the shares. So if they sell little parts of the company, they can sell them for certain dollar amounts to make sure that the company itself earns some money from doing that. Disadvantages: companies must deal with government. Constant fees. So constant fees. Companies are also accountable to their shareholders, so they're not completely in control of their own destiny. The shareholders vote to make changes. Sometimes this might not be good for the future, but the shareholders are worried about the value of their money. So accountable to shareholders, decisions made by shareholder vote. So that's another disadvantage, but the major advantage and the main difference that companies you're gonna experience when you're doing the business taxation part of this chapter is the fact that, and you can see this as an advantage, so I'll put a line down here. Companies are taxed a straight 30% of taxable income. No Medicare to deal with. And the importance of this will become clear later when we start doing the actual calculations. But basically, if we go back up here, sole traders are taxed like individuals, just like you and I. Except they're just a business. But the way you calculate the tax is exactly the same. Partnership, each and every partner in the partnership is taxed individually. So the whole business is not taxed like an individual. The split of the income to the different partners of the business, and then those partners are taxed like individuals, so it's not that much different. You just have to do it multiple times. And then finally, a company, one of their biggest advantages is the fact that they are actually taxed at a straight 30%, so not like individuals at all, and they don't have to worry about Medicare, which the importance of which will become clear when we do the next exercises. So that's the advantages and disadvantages of the different business structures. Hopefully that helps you out for the coming exercises, and I'll see you in the next video.